Good afternoon. My name is Dominic Oud. I'm a partner at Drakestar Partners, the technology and investment bank, which is focused mostly on the fundraise and M&As. And I look after mostly the mobility sector at Drakestar Partners. I would like, importantly, to thank EcoMotion for hosting this panel. I think the topic of investments in the mobility sector, in the emerging mobility sector, is a very important one. We see a lot of changes taking place now. In fact, if we look at some of the statistics from PitchBook, just in Q1, we had even more than 300 transactions completing in an amount transacting of above even $23 billion. That's only for the Q1 of 2021, all forms of transactions combined. So it's already quite a lot in terms of volume, but also the diversity into the type of investments is increasing a lot. So I think to cover that in the best possible way, we thought of bringing you three very different type of investors here who are currently on the panel. First of all, we have Sophia Nadur, who's a managing partner at BP Ventures, which is the global CVC of BP, the oil and gas company. We also have Tarek El Assawi, who's a principal of Plug and Play Ventures. Plug and Play is an early stage investor that has been very active in the mobility space with more than 10 investments in the last few years and actively involved in generating others. And finally, we also have Christian Noske, who is the partner at Target Global, which is a growth stage VC in Europe and Israel, also present in the US, and very active as well in the mobility space. And prior to that, Christian was the head of Alliance Vector, which is the venture arm of the Renault-Nissan group. So I think that what we see here is that clearly, there's really a lot of evolution into the acceptance of a new mobility. And I think what we see is that certain technologies which were extremely advanced or depending of evolution of the electric car markets or even certain autonomous vehicle technologies are getting a bit closer from the inflection point. In other words, the risk factor of certain of those companies and products is becoming lower, which brings sometimes capital that can be a little bit more in some way traditionally less risky. And I think it'd be interesting to see from your point of view, from all three of you, how you see this taking place. Because, for instance, in the EV charging world, especially maybe on the asset space, we now see infrastructure funds coming in and saying, okay, well, we'll take a long view to that. We're now accepting that this is a legitimate asset class because the demand and the utilization in the right markets for EV charging is now starting to be acceptable. So it'd be interesting to see beyond, of course, that example, how you see this and maybe how it works or how you see that in your own, and I would say with your own investments, maybe starting with you, Christian.
Yeah, thank you so much, Dominic, and great to be here at EcoMotion again. I think I see it mainly in two different sides. On the EV side, of course, as you described, we see a lot of innovation around batteries. It's nothing new, but now the batteries are becoming such a sought-after product by the OEMs and really a scarce product in the near future, in the next couple of years, that we will see a lot of, let's say, bigger type of investments that are maybe not typical to VC and more typical to banks and infrastructure investors. A famous example in Europe, of course, is already Northvolt, which sets up a couple of gigafactories and is working with VW and BMW and so on, including also on the cap table. Another example I would bring up is autonomous driving. We are still in the infancy of the technology, and we don't really see bigger deployments, but in the next couple of years, we will see lots of structured deployments, means autonomous vehicles in a certain setup that will do, what they are supposed to do, autonomous transportation of people from A to B in a very fixed setting, maybe only between 6 to 6 or something. And here, lots of cars need to be deployed, lots of hardware needs to be deployed. And so different asset classes will back those type of hardware investments in the near future as well.
And from your point of view, maybe Sophia, into the various transactions or assets you have, or asset that you have, either that you had or that you currently have within BP Ventures in mobility, how does that play maybe the different type, maybe of risk profile between the businesses, and how you look maybe at co-investors in that case?
It's a good point. I mean, you're right. I mean, I think the marketplace is at a cusp of development. You're seeing the forecast is about 250 million electric vehicles on the road by 2030, which then requires, let's say, 6 times the amount of electricity demand that we have today. So there's clearly a real market need. I mean, in the UK, for instance, I mean, of course, BP knows how to lay down gas stations, but to be able to help accelerate the availability of EV charging hubs, we've been partnering in a different way. So we've been using the support of an infrastructure trust called SEEIT, who has put £50 million into a company which is helping us deliver EV charging hubs to the UK. And that's something which is something different from what we would normally do. Normally, we would take our own cash and then put it into the market. Likewise, we have found ourselves much more open to co-investors, for instance, when we get into even early stage companies, because now we see that even the so-called legacy companies who are looking to decarbonize and digitalize their operations are needing to work together. And so we are quite open, much more open than perhaps in the past, in having other companies come and be co-investors and work with us, because actually sometimes it's not just what BP needs to help this company unlock value in the market, but it's working in collaboration with partners helps unlock. I mean, we've done a number of joint ventures with other companies, Equinor and offshore wind, for instance, and we have announced an MOU with Jinko Solar in China. Now, these are big companies coming together, but within those MOUs, there are lots of opportunities for startups, for other companies to come and help close a lot of the technology gaps, which a lot of legacy companies happening. So we're seeing quite a different approach to the way we go fish, but also how we then bring these investments to market.
Yeah, thank you, Sophia. And I guess it's an interesting one as well for the purpose maybe of the early stage investor as well, Tarek, because I think that even when an entrepreneur or a company from a fairly early stage starts a company, they may be literally just a year or two away of having to deal with much larger and much more complex investors than before. I think we have seen recently companies that maybe started 2-3 years ago and already having to think, okay, maybe I will have to deal with certain institutional investors, T. Rowe Price, Fidelity, and so on. And I think that is kind of unheard of, but it seems that from the early stage, I would say the guidance maybe from maybe the early stage investors, maybe sometimes the CVCs about, look, this is how this financial picture is, how complex it is, appears to be even more important than ever because of that complexity.
Yeah, absolutely. You're absolutely right, Dominique. Basically, the time horizon for a lot of these companies has shrunk dramatically. There's been a lot of recent developments where companies are going public after just a couple of years of operating, and so companies need to get prepared for that process even earlier than possible than normally. We have even some of our early stage companies, which are just a couple dozen employees, are hiring CFOs with public company experience to prepare the company to go public. So the idea for when we initially invested in some of these companies, we thought maybe they would have a quick exit after a couple of years, or go public, or a large outcome in like 7-10 years maybe. Now that idea has really shrunk down, so we're trying to get all of our portfolio companies prepared to accelerate their own growth very quickly.
Yeah, because it seems that indeed that kind of additional expertise or up-to-date expertise, I mean, it's not just a matter of finding, I mean, as an advisor, the right financial advisor or investment bank. I think it has to be in a way even more organic than that, and having maybe the right investors from the very beginning to help being guided in that direction, in that kind of more complete environment going forward.
Absolutely.
Okay, no, thank you very much. Maybe as a second topic, and I think we will come back in the context of the SPACs of like the institutional capital coming into the e-mobility sector in a way that we have not seen before. But I think that before we go to the institutional investors further, we have, of course, some of the large corporates I think that have been involved by dealing directly with many, and that applies, I think, with many startups and companies currently present in Israel. And I think you have, I mean, I think from the point of view of you, Sophia, at BP, and also from perhaps maybe from a previous experience question with Alliance Venture, I think that kind of corporate investment into either the startups or advanced technology companies can be quite unique, especially when there's like a corporation project that has to take place, and of course the speed of operation of the companies is quite different. I think one example is perhaps would be the automotive industry, where well, let's face it, I think there's a major change taking place in the auto industry, and I think for the OEMs it's not exactly pleasant. I think you have the core business that is like drastically being redefined completely, and then some of the expertise which is key is not necessarily anymore in-house, but somehow is, at least for some of it, in really among certain very unique small companies that they have to deal with. And of course, the one solution, of course, is to invest a minority stake in the good old like a startup. However, it's not enough just to attend a few board meetings per year. There has to be proper project, and even the typical joint projects, the usual amount of time might not be enough. I don't know, maybe from your point of view, Christian, from the having done it from automotive point of view, whether we see maybe kind of some changes, or indeed some changes need to take place into how, say, a large car company, or maybe in the energy side of Sophia, if we have to rethink a little bit how these joint development projects take place. Are we leaving enough time for say sort of, and of course it will depend from one product to another, but to synchronize currently? I mean, we heard quite a few stories for car companies that it's not always the case. So curious to hear maybe some examples, Christian, because I think it's very relevant for many startups here in Israel that actually have among their shareholders, even in Series A, Series B, lots of these OEMs.
Yeah, Dominic, and as you know, I was also at BMW before, so I have like the, I guess, the German, French, Japanese perspective maybe on your question here. You know, there is a perspective that startups really need to understand, why is an OEM doing this, or why is any corporation doing this, right? And there's a little bit of growing up to do. I think many corporation thinks that the startup investment is the holy grail that will save the company and will save the future and everything at once. You know, this is just one tool set, right? This is one tool in a big collection of tools that need to work together. It's not just, as you said, Dominic, a small investment will save my company. There's a big kind of follow-up needs to happen there, and I think BP is doing it in a very interesting way there, and many others also have a very close link between the business unit and the VC. And here, as a startup, you need to ask, like, is it too close, or is it close enough, or is it too far away, right? All of those are or could be potentially problems for you. If it's too far away, you don't really get the value. Is it too close? And the VC acts like a business unit, and you know it might be too slow for your taste. So here, understanding that. That success is not measured, that every single investment needs to be integrated, I think is one question a startup can ask. Another one is, what are the tools? What is the link to the business unit really? Is it on C-level? Is it on working level? Sometimes the C-level executive cannot force the business unit just to do what they want to do. So really understanding the level of touch point is important there. And then to be more specific, and maybe to be very specific on technological problems here. Of course, we all know joint development agreements. I think especially in battery development or battery investments, has been something that is I think common practice. But here, I would still hope for the industry to develop a little bit more of a muscle of being startup friendly, but still being fast, and then getting the best out for both parties and not being stuck in their kind of old agreements. And startup also to understand that the OEM also needs to get something out of it, right? It's not just like I'm getting all the stuff and the OEM doesn't get anything. So it really needs to be a fine balance. Another one is joint ventures. I think joint ventures, in my opinion and next experience, is a little bit problematic. I haven't really seen joint ventures working out so well. So if you can do it on a project basis, it's a better way for a startup, in my view, because you're not being influenced by the governance on the joint venture of a big company, but rather just on the project. So just my 2 cents on the topic.
Thanks. And maybe Sophia, from your side, I think what is interesting if we compare the oil and gas and the automotive industry is that while perhaps the overall technology cycles or maybe not the same speed, maybe on a longer term in the oil and gas, some projects can be a bit smaller, can be more manageable maybe than just a large car platform or a brand new car model. How does that play maybe in some of the companies you deal with? And is there anything we learn and we can continue to learn on this?
It's a good question. So I'll answer it in two ways. First way is that, I mean, BP Ventures and BP has learned a lot in the last few years in terms of what it takes to win this space. And so, for instance, some of the early investments, so for instance, once a startup is let's say, willing and able to consider pivoting if needed to be able to go after a bigger market space and maybe what you had originally envisioned. To give an example, we had initially put $5 million into a Californian company called FreeWire, which had a nice mobile charging, which was powering food trucks. Now that's a $1 billion opportunity globally. We worked with them and we have experts in our business, not in ventures. We kept a Chinese wall between us, but that work together has now helped to pivot this company to now creating a battery integrated EV charging offer, which has just won them a $50 million contract with our BP Pulse business in the UK, and they're now going after a $40 billion market. You know, so the thing is that having this little bit of investment, but understanding that BP can provide then that platform to help you grow further and being open and willing to pivot if needed, that's actually quite useful. But not every startup wants to do that, and we completely get that. And sometimes, as you say, let's say a very light touch JV type activity might be the best thing for that startup to be able to just understand and refine its offer. So for instance, we offer this kind of POC pilot, no strings attached, any sort of risk money for us to support you without even taking a stake in your business at that stage. Then of course you have the classic minority equity investment, which we might take, or we actually have now something called Launchpad. If you want to help stop, let's say, having to worry about fundraising and you just want to help develop and go after the marketplace, we now have a Launchpad type offer, which is horses for courses, depends on what the startup needs. And I think to Christian's point too, I think we need to really understand what it is that the startup is looking for and not just try to shop a solution, but really understand what it is that startup is needing to be able to get to the next stage of development.
Yeah, no, certainly. And I suppose that, I mean, even at a fairly early stage, I mean, Tarek, you have, I mean, one of your investments was Deepscale, which was sold to effectively a large corporate. I assume that some of the entrepreneurs, some of the companies go to you as well, asking you, well, how to best cooperate with the corporates, and whether do we get into this joint development or should we almost go to the route of the exit possibly? I mean, sometimes you have, so they can be better integrated ultimately into the company. I guess sometimes the I would say the request for advice to you comes around this topic.
Yeah, no, for sure. I think that's probably one of the main topics that we get asked about. You know, at Plug and Play Ventures, we primarily invest in enterprise-focused companies, and on the flip side, we have a corporate innovation consulting business where we work with large corporations, including BP and Renault-Nissan Mitsubishi Alliance, for example. We work with them to help connect them to the startup world and advise them on how to work with startups. So we get these questions all the time. And I would say like a lot has changed over the past few years. I think when we first started working with large corporates, we saw that there was almost like a disconnect between some of the innovation activities and the core business units. And there was almost like an adversarial relationship. And oftentimes I think startups were a little bit more fearful of talking to these large enterprises. They didn't want to necessarily have to go through all the hoops, as well as potentially have some of their IP stolen or something like that. But I think things have improved dramatically, especially in the automotive space over the past decade. And we've seen, like, for example, we have a program in Germany that we operate called Startup Autobahn, where we work with a lot of large automotive companies, including Daimler and Porsche, and they actually have dozens of different business units involved with the program and hundreds of executives. So that culture of innovation has permeated within the organization. And as a result, we're seeing much quicker results for startups that we've invested in to actually execute pilots, to get deals done. So things have improved for sure. We're always very cautious when we're advising companies on taking capital from corporate, what are the strings attached and so on. But I think things have really dramatically improved over the past 5 years.
Yeah, great. No, certainly. And maybe since you're there, Tarek, we can even move to our third topic today, which is the trends we see around, of course, the SPAC and the SPAC being applied to mobility companies of all sorts. Some of them being deep tech, others being more clean tech related, effectively. And I think what is really interesting is that there's still a bit of a debate. I mean, maybe separately from the current dynamics and momentum around the SPAC, I would say, market itself, but also as well, is this really the right thing for companies at a certain age, at a certain stage of development? Because in the context of a successful SPAC, what we do is that we provide sometimes an entrepreneur with significant war chest and ability to further grow the company, while the goal of course, doing the organic growth, especially if you're early on, is still extremely important. So that becomes quite a significant task. So I think the question is on one hand, maybe to all of you, but maybe Tarek to start. I mean, are SPACs finally something that fits well with mobility company, and maybe to the extent it does, which company in Israel probably or would be well suited for that based on the examples we saw recently, because I think that's quite an interesting question mark there in terms of what we see in the sector.
Yeah, I know those are all really good questions. Obviously there are a lot of pros to getting a big war chest up front and being able to separate yourself from competitors. And we've almost seen, like in some areas, like for example, autonomous vehicles or EVs, there's almost a race to get as much capital as possible, just because if they don't actually go deploy quicker, if their competitors are able to get that war chest before them, then that's an existential issue for the company. So there obviously the pros to doing it are clear. From our perspective at Plug and Play, we're really early stage investors, so we've seen a lot of interest from companies that we've invested in, let's say 2 to 5 years ago, for going that SPAC route. It's opened up a whole new world of possibilities. That said, obviously there are cons to going public so quickly. A lot of the teams that we've invested in, let's say they're highly technical, or they're just building their business chops. Maybe they're just not ready to be founders of or running a publicly traded company. There's a lot of headache associated with that, and so they have to bring in other experienced managers to support that. And then of course what we've seen now recently, there's been a slowdown, of course, over the last month in the SPAC market. That we anticipate that will change as there's regulatory updates, and we've seen evidence of that just in the past week with Bird and Plus AI announcing they're going public via this method. But what we're expecting is a flight to quality for sure. A lot of the companies that announced or are pursuing SPACs, a lot of the targets ended up not going through with the process. So we're definitely expecting a really a strong shift towards quality, and those are the companies that really need the money. Is the companies that are ready and have the right technical, the right product, the right team, the right story to actually use the money appropriately. Because going from having 30 million, 40 million in the bank to 500 million is a huge jump, and being able to spend that wisely is really important.
So it looks like the selectivity that we start seeing into certain elements of the market, maybe on the private placement side of the market around SPACs, should almost be replicated by selectivity, maybe from the company side to say, well, should I really go in this direction? Is it the right time now, given our stage of development? And Sophia, I think from your side, I mean, you have some companies in your portfolio that went in that route recently. How would you see that?
Well, we've got 2 companies currently exploring it, which is not in, let's say, in the public domain yet. But there's one company, so Lightning Motors, now Lightning E-Motors. Yeah, they've just announced the completion of a SPAC, which, I mean, okay. So the question is SPAC good or not? Actually, first of all, it's another tool in our let's say arsenal in terms of liquidity options. So in that point of view, it's another option available to CVCs like us. Obviously, it does end up being sometimes a competition for us when we now are in the investment stage, looking for companies, and maybe some companies should be or might normally be looking at Series B funding, but instead they're in the process of looking at a SPAC. And then sometimes we ask ourselves, is it the right time for the company or not? But that's, again, it's a race right now. And I think we're in a nascent category, e-mobility, and there is potentially huge growth curves ahead of us. How quickly can companies get to market and to take advantage of that, let's say, mass market adoption, both from fleets and customers? In my view, we probably have another 5 to 15-year window when you would get the strongest growth options. So frankly, companies need to be looking at a SPAC as an option, but it's not right for everyone. So this, and the question is always, when is the right time for a SPAC? Who knows? Yeah, but I mean, we're very open to that as an option, as a liquidity event. Of course, like I said, it does create competition for us, but for some companies, they don't want to do it, and perhaps companies like BP can then step in and provide the capital needed if, for instance, they want to stay focused in one industry and one sort of expertise. So I'm not sitting on a fence. I do think that it's the right option for some companies, but it's not for everyone.
Yeah. So it's about really about the management team together with their shareholders to really look at the scenarios and what fits the best.
Absolutely. Be very, very careful, because once you're in the public domain, it's a different game. I'm part of a company which is in the public domain, and it becomes a very different way of operating.
Yeah, no, so yeah. Thank you very much for that, Sophia. And maybe quick question, your point of view on that one, and maybe also on one element of the SPAC market that's evolving now. I think because what we see is that people see it as a slowdown. I think there's a certain selectivity clearly in some of the private market part of it, where we'll see, okay, well, now there's a lot of companies where we can invest. There's a lot of SPACs themselves. Let's look more carefully at the company, the teams, and so on. But I think looking at the other side of that point, are there perhaps some characteristics of some of the SPACs that are becoming more important because of it? For instance, you have behind SPACs teams of sometimes people with a lot of experience of the industry that are behind the SPAC that will somehow merge, combine, or be involved with the current management of the companies. So what does that mean for the entrepreneurs? So they themselves look at this, okay, this is maybe a unique advantage I will get from out of the large choice I have. Is that something they should look at more carefully?
I quite agree. I think the company needs to look at it quite carefully. Sorry, Christian, I think you could comment as well, but I think there's something which is it's quite a challenge, because many entrepreneurs want to be a CEO as well. And sometimes you don't get that opportunity if you go into the reverse mergers. So it's a challenge as well.
Yeah, I mean, I think it's important to understand a little bit where we are right now in the SPAC world, right? We have over 800 active SPACs, like in various stages, of course, but over 800. So you need to understand if you're CEO, like, what does it mean for you? And also you have to understand why you're actually going after this. This is not because SPAC brings you so many advantages kind of on the structural side, like you're a public company, you have to do more, all of this. And so why are startups doing it? Because they get the promise of 2 or 3 times higher valuation than what they can get in the private market right now. I mean, this is the truth, right? Nobody goes public just for the sake of going public. So I think that's one honest truth that CEOs need to remember. And then the second one is, like, if you get interest from a SPAC today, this doesn't mean anything. Like everybody gets interest from a SPAC these days. This is like, feels good, right? Like, oh yeah, you can be valued at $1 billion. Last round was at 200. Like, oh great, I'm a unicorn. Like, it's a lot of ego stuff, right? Like, you feel great. But like the SPAC side is fishing right now as well. Like, they're looking for targets. So they're speaking to 20, 30, 50 companies, the same way that a VC looks for investments. It's exactly the same. It's just a different stage now. So you should remember that, and you should know that you might waste your time going into that and nothing ever will come out, as we already heard. So the other element is like the risk in the market right now on the public side, like, and Dominic, your question there, I think there are good SPACs and there are bad SPACs. I think the good SPACs criteria, in my view, are you have a very experienced management team with domain expertise and domain network. So, if you're an EV charging company and you have some former CEO of like a BP Energy or somebody that sold basically to all of those guys before, great, perfect. The second element I would be looking at is how much money are those guys bringing themselves? Because there is a bit of a notion of making a quick penny as just while you're doing the transaction without having any success, you're already getting rich of it potentially. So I think seeing that they're in for the long term and they're investing real dollars is important in my view. It's part of this, like, not to get too technical, of this PIPE process, right? This investment that comes after the finding the investment round for de-SPACing in the market, that this SPAC team also invests a lot of money in this PIPE. I think this is another element. And then to the most basic question, Dominic, that you asked in the beginning, like, why SPAC and mobility? Why is this a topic? This is not a SPAC panel, right? So I think the mobility sector has something that many others maybe don't have, like classic VC sectors, which is a lot of hardware, a lot of like heavy assets involved. There's a lot of software, but also heavy assets. So naturally you have more, you need bigger pockets, as we talked about. You need capital market investors. And so therefore, I think the whole SPAC euphoria was started by a lot of mobility deals last year, because they need those giant pots of money. And by the way, I think it's also a little bit of a counter reaction to what we have seen the years before, where we have been extending more and more and more all the private rounds that we have seen. And now we're seeing a counter effect. We're going earlier into the public market. I think the truth is somewhere in the middle, and we'll get out of it in a couple of months, I think.
Yeah, thank you, Christian. And a big thank you to everyone, because for this kind of nice debate and open conversation. I think are pretty important topics for investors, for entrepreneurs, especially today. And I hope we will be back in the future at some point to continue, because no doubt, I think this topic and the subtopics we discussed will evolve. So again, a big thank you, Sophia, Tarek, and Christian, for participating today.